This is Fritz Meyer on June 10th, 2015. Yesterday we did the monthly webinar, which lasted 60 minutes, but I ran out of time. So I wanted to come back and cover just a couple of other items from that webinar, which I thought might be of interest this month. But before I do that, I'm going to spend a few minutes talking about and responding to questions that also came as a result of yesterday's webinar. Here's the first question. One of the heads of Goldman Sachs opined on TV earlier today that the median stock is trading in the 98th percentile and concern about buybacks propping up stocks. Is it possible stocks are expensive when looking beyond the average PE on operating earnings? What about price to sales? What about price to book value? Enterprise value to EBITDA, and any other host of metrics. Your thoughts? Yes, I do have a few thoughts. First of all, there's no question that stocks are trading at what some consider to be elevated PE ratios, but as I stressed yesterday, I don't believe that's the case if you look at operating earnings compared to the inflation backdrop. PE on operating earnings compared to the inflation backdrop, that's critical. And so in my view, we're actually at a very normal PE ratio on operating earnings. But on the other hand, price to sales, for example, is elevated. Now consider this, and consider the reasons behind price to sales being somewhat elevated. The reason for that is we are also at record operating margins, and so whereas price to earnings looks normal, that would the fact of record operating margins would mean that the price to sales metric does look elevated by historic comparison. The real question is then, are record operating margins sustainable? And there I think the answer is very likely yes, because of the reasons behind the record operating margins that we see today. One very important consideration has been that we have been gradually substituting capital for labor. We, meaning S&P 500, the S&P 500 companies, and even more broadly, the government's NEPA calculations show that across the economy, companies have been substituting capital for labor, becoming more profitable as a result. So it's been a profitable trade for companies to gradually substitute capital for labor, which means that they've gradually been applying technology to their businesses and becoming more productive. I don't think that process is going to reverse anytime soon. So I think that profitable substitution of capital for labor will continue, and hence the higher margins that have been the result of that substitution will persist. The second aspect to record high profit margins has been both interest expense as a percent of total sales and taxes, corporate income taxes as a percentage of total sales are at record low levels. And in both cases, for example, with respect to interest, yes, I suppose to the extent that interest rates turn around and go higher from here, we would see somewhat higher interest expense as a percent of total sales, but nothing nothing substantial in that, in my opinion, which is to say, long-term bond yields may go back from 2% to 3%. Is that going to significantly impact corporations' borrowing expense? I don't think so. And finally, with respect to taxes, no. If anything, corporate tax rates will be changed in a positive direction. To the extent Congress ends up taking any action in that regard, I think the impetus is, if anything, is to cut corporate tax rates to bring the U.S. more in line with foreign corporate income taxes. Okay, so that is perhaps a long-winded, but what I intended to be a comprehensive discussion of the price-to-sales ratio. Now, price-to-book value and the so-called Tobin's Q measures also, I think, deserve some discussion, which I did 2 months ago and I presented this slide 2 months ago in our monthly webinar discussing all of the bubble arguments as put forth by this Forbes contributing author, one of which was the argument for high book value, price to book, and high Tobin's Q. Tobin's Q is price to replacement value. So price to book value and price to replacement value is the subject that I wanted to discuss here for a second. And I think it's the most important consideration is that these, for example, these top weightings in the S&P 500, Apple, Microsoft, Facebook, Google, Gilead, Cisco, Oracle, Visa, Amgen, and Biogen. I went through the S&P 500 and I picked out those companies, those Goliath companies, those companies which have grown into Goliaths just in the last 30 years. 30 years ago, these companies didn't even exist in the S&P 500, and today they are among the top earners and market caps in the index. Now, what about these companies? Well, in every case, they are extremely asset-light companies, their value being in intellectual property, which doesn't appear on the balance sheet. So just the concept of book value or replacement cost is an anachronism. Especially when it comes to this group of companies. And therefore, I think price to book and price to replacement value as a concept just no longer is particularly relevant. And again, you have to take it back to price to earnings. The PE ratio, I think, is the single most important measure. I just read a great mutual fund manager noting that there have been only 3 periods in the last 53 years in which the S&P 500 index returns have exceeded earnings growth for 3 consecutive years. And he feels there are no areas of absolute value within equities or fixed income. Your thoughts? Well, first of all, I just wanted to show you what the questioner observed here is absolutely correct. As I pointed out yesterday, the S&P 500 is up an average of 20% 3 years in a row, up 60% over the last 3 years, compared to an average earnings growth trajectory of about 7.4%. So there is no question that stock price appreciation has been vastly outstripping the underlying earnings driver of stock prices now for 3 consecutive years, and that is very rare. But the major point I made yesterday is that is because the S&P 500 over the last 3 years just completed the 6-year process from which it has been reverting to the depths of the recession market bottom in March of 2009 has been reverting to normalcy. In other words, we spent 6 years reverting to the long-term mean rate of stock price appreciation of 7.4%, and the tail end of that process, then the last 3 years that we were just referring to, up 60% over the last 3 years, is the final phase of that reversion to the mean. So on the one hand, the observation is absolutely correct. On the other hand, to say that there are no areas of absolute value in either the stock market or the bond market, I think is well, let's put it this way. I guess the question is, what do you consider to be absolute value? If you mean, well, stocks being extremely depressed compared to their long-term trajectory, as illustrated in this chart, I would agree with that. Certainly, whereas stocks represented extraordinary value at the bottom in March in 2009 and less extraordinary value as stocks have been closing that gap to reversion to the mean. Then today, if you said stocks are simply normally valued, then I guess you could say, well, there is no really extraordinary value in the stock market remaining. I guess I'd agree with that. But on the other hand, if you to say that there is no value in stocks, I think probably is not an accurate statement. I consider that stocks are normally valued and then will, by extension, continue along, very likely continue along these normalized valuation paths going forward. Specifically, something like the 9.5% total return path that you see in this chart, to me, would make perfect sense. Whereas we've seen something well in excess of that in recent years, but going forward, that to me continues to look like the path of least resistance, because I think the economic expansion will remain on track, and I think corporate earnings will continue to drive stock prices higher at a rate consistent with historic norms. The next question from yesterday: what was the rate of return for example, that an investor would have gotten if he had invested in the stock market the day after Alan Greenspan's irrational exuberance speech in 1996? And so I prepared this chart in response to the question. Yesterday, you may recall that I referred to Alan Greenspan having coined the phrase irrational exuberance in December of 1996. And so here's the calculation. At that point, the stock market, the S&P 500 total return index, what you're looking at in this chart, and remember that is as distinct from the S&P 500 price index, and so that's why the numbers may look not recognizable to you, but this is the index that matters, because this is the index that includes reinvested dividends. So 216 on that index in December of 96, 872, roughly a quadrupling in price, works out to 7.8% compound annual growth, again assuming an investor had bought the index the day after Alan Greenspan uttered the irrational exuberance phrase. So very healthy, respectable return long term, not too much short of the 9.4% that I showed you compound annual over the last 25 years in the S&P 500 total return index. Are you aware of JP Morgan economist Michael Feroli's call that future GDP growth will be less than 2% because of a lack of technological progress? Your thoughts on this? Yes, I'm aware of Michael Feroli's discussion of that, and he's not the only one. There are actually a number of people in academia who are wondering the same things. The question, though, refers back to this chart that I presented yesterday, which is the CBO's, I think, schematic more than anything, but this in fact is the Congressional Budget Office's latest 10-year forecasted GDP growth, actual versus a calculation of real potential GDP. And as you can see in this chart, CBO's baseline forecast for the rate of economic expansion in the United States is 2.2%. And the way they get to that forecast, and also the hypothetical rate of real potential GDP growth, is to add growth in the labor force plus productivity gains. That's the equation that comes right out of the economic textbook as being the two independent variables that drive economic expansion, not just in the United States, but any economy. And I'll say it again. How many more people are working in the United States economy this year compared to last year, plus how much more is each of us contributing to the national output this year compared to last year? The sum of those two gives you actual and potential GDP growth. And again, the estimate here is 2.2%. But the question is it possible that we won't achieve that level of GDP growth going forward because of the lack of contribution, significant contribution from the productivity element in the two basic drivers of economic expansion, productivity growth plus labor force growth. So here is a picture of actual historic productivity contributions to U.S. economic output going back to a little over 20 years to 1994. And you can see that the most recent 5-year average productivity gains have only averaged 0.7% per year. And yes, that is materially short of what we had experienced in previous decades. So specifically, if in this chart, for example, you just ran a line through the productivity gains that we've been seeing up until the most recent recession, the answer would have been, well, something more like 2% has been averaged, maybe even a little bit north of 2%, having slumped then post-recession down to this dismal less than 1%. So it is a good question. It's a very valid question. My own view on this, however, is that first of all, note how these collapses in first quarter GDP growth that we've experienced now for the last 3 years, 4 years actually, that I referred to yesterday, have been, they have actually been one-off events, but those have significantly pounded productivity, because productivity arithmetic is such that if you have a big contraction in economic expansion, but you have the same level of workforce, then you get a huge contraction in productivity gains. So those in and of themselves have significantly subtracted from productivity just over the last 4 years. And so I don't know what to say about that other than they really do appear to be one-off events that have occurred in the first quarter, fourth quarter, or first quarter of the last 4 years running. But my own view is that no, I think we will revert eventually back towards the kind of productivity gains that we have been seeing in recent decades. I don't see any reason to suspect that that won't be the case. I think probably companies will continue to invest in, research and development and then apply that research and development to productivity enhancing investments across the economy. But again, I think it's an excellent question, and it's one that's being raised in academia, and there are professors on both sides of that argument who have been arguing vehemently one way and the other. Okay, back to the material that I skipped yesterday just in the interest of time. I wanted to take you through the CBO's latest calculations with respect to the federal deficit and the federal debt. And the reason for my having included this segment in yesterday's presentation relates back to my covering Ron Paul's sort of hysteric rant on long-term collapse of the U.S. economy, collapse of the U.S. dollar, rampant inflation, and so forth, because part and parcel of that argument, not just being made by Ron Paul, but other people, I think fringe people, very definitely in my view, fringe sort of pundits, and whose names I went through yesterday. But part and parcel of that argument is that the federal government has created a situation where long-term spending will ultimately just absolutely spiral out of control, taking us into that dark hole fiscally from the federal government's standpoint. I don't agree with that, but let me just take you through what the numbers are. What you're looking at here is the Congressional Budget Office's latest 10-year forecast for both spending outlays and revenues, tax revenues. And so what you can see is that in the first roughly 4 years of this projection of forecast, you see that revenues continue to surge with economic expansion coupled with the most recent tax hike, the ATRA, American Taxpayer Relief Act, tax hike that was initiated in January of 2013. So revenues continue to surge and thereafter more or less flatline out here. Whereas outlays as a percent of GDP, by the way, both of these figures are expressed as a percent of GDP, have come down very precipitously post-recession and don't pick up substantially as a percent of GDP looking all the way out here for 2019. So that the federal deficit, in other words, the difference between revenue and spending, actually continues to contract here all the way out through 2017 and all the way out through 2019, you see, doesn't start creeping higher than the long-term average, the 1965 to 2014 average. So actually it's a very positive outlook scenario being painted by CBO in their latest 10-year forecast of federal deficits. Thereafter you can see that the deficits continue to climb, and the reason for that is that the entitlement program spending, the entitlement programs haven't been changed. But another look here as the federal debt as a percent of GDP. In other words, to the extent that you're running deficits in any given year, you're adding to the total stock of federal debt outstanding. But you can see that all the way out through 2025 then, the total federal debt as a percent of GDP does not increase very substantially, 5 percentage points, but still considered by most economists to be very manageable, anything under 80%, very manageable looking out the next 10 years. This, by the way, is the reason for the whole topic having disappeared from the front pages and also in television media. Whereas at the height of the recession, there was a lot of hysteria relating to the topic of whether the United States would actually default on its debt and so forth. Amazingly, the entire topic has disappeared from the headlines, and the reason is because the recovery plus the tax hikes with the 2013 tax hikes have combined to really mitigate the deficit and debt situation considerably compared to where we were at the depth of the recession. And in fact, you can see in this from the IMF, their most recent publication of government debt to GDP ratios, this one goes out through 2019. You can see that the United States figure actually is, as I said, very manageable according to this set of projections. But looking beyond 2019 or 2025, then you can see, as I just mentioned, the entitlement spending problem has not gone away because the entitlement programs haven't been changed one whit. And it was a shame back in 2010 when Simpson and Bowles rendered their conclusions to the president that was a nonpartisan, it was a bipartisan set of recommendations that the president didn't take them up on, some of those proposed changes, and make these entitlement programs long-term sustainable, because clearly they are not long-term sustainable as they currently exist. And you can see that, among other things, the interest burden that accumulates simply as a result of increased spending on Social Security, Medicare, Medicaid, and so forth continues to rise. And so that if left unchanged, then you can see in this long-term set of forecasts, again, CBO's latest, looking all the way out through 2050, whereas looking out through 2019, the period of time I was just addressing, the situation remains very manageable. Then beyond that, ultimately, you run off the rails from a fiscal standpoint. And so something will have to change with respect to those entitlement programs. But I think all of us understand that the way that our political system works is that unless and until the crisis actually is staring us in the face, probably our politicians will not do anything with respect to making these programs affordable long term, because it involves telling the American people that the promises that that they made historically are not sustainable, and we're going to have to take something back in the way of how generous these programs are. My own belief is that actually the changes that we ultimately have to make to the entitlement programs, Social Security, Medicare, Medicaid, are going to be accepted by the American people. First of all, not draconian. These programs simply have to be made a little bit less generous, but certainly not draconian, like some politicians were saying in the last election, putting an extreme face on these, pushing grandma off the cliff and so forth. No, that's not the case. These programs can be made long-term affordable with relatively modest changes, but again, those changes will have to be made, and no politician wants to step up and sponsor those changes unless and until the crisis is staring us in the face. All of which is to say that hysteria, like the Ron Paul message, I think is really ridiculous. It's basically stating to the American people that our political system is simply incapable of making necessary changes long term. And of course, the government will just run right off the rails because it's baked in the cake with these entitlement programs. I think that's just a silly argument, and that's why I don't buy for a minute that kind of hysteria. The final point I wanted to make yesterday, that not final point, but one additional chart that I wanted to bring to your attention yesterday, which I didn't have time to do, but I found this a fascinating chart in Investors Business Daily, published just a few days ago. And this is related to the argument, the political argument that the parties go back and forth on, relating to this question: is U.S. capitalism creating vast dynasties of wealth hoarded and passed down by a select few families? And to the extent that you would answer that yes, then the next question is, well, is that a good thing long term for our society? And Warren Buffett and Bill Gates, for example, have pledged to give away all of their wealth, I think before the end of their lives, or I guess immediately upon their demise, but they've pledged to give away all of their wealth. In other words, not pass it along to their heirs. In the belief that that actually is a better thing to do for the rest of society. So again, it's this debate that I'm addressing with this chart, and I'm not taking a stand here one way or the other. But this data relate very directly to that question, that issue. Is U.S. capitalism creating vast family dynasties? In other words, creating over time, over the centuries, American aristocracy, because I think a lot of people would argue that that is not a good thing, and that led to serious problems in Europe historically. Well, the answer to that question, I think, is no, U.S. capitalism is not over time creating those vast dynasties, because what happens is only 1/4 of the wealthy families in 2014 were on the 1982 Forbes list of the 400 wealthiest families, and their aggregate wealth equals just 39% of the total wealth held by today's elite. In other words, whereas the Forbes 400 possessed 100% of the Forbes 400 wealth in 1982. Today, that group of families is down to just 39% of the total represented by the Forbes 400. And so the punchline here is great wealth, once established, dissipates at 3 to 6% per year in the United States through spending, charitable giving, and taxes, the pace accelerating with each generation. I just found this data to be very interesting, and also in my mind reassuring, to the extent that that you believe, and actually I do personally believe, that creating family aristocracies and giant pools of wealth that just persist decade in, decade out is probably not a good thing for society long term. Well, it appears to me that that problem actually solves itself over time, and it's not something we have to necessarily be too concerned about. The next article that I clipped for yesterday's monthly presentation, again related to gold, because this article appeared on June 2nd in the Wall Street Journal, and I had addressed the subject of gold in the May monthly webinar, so I'm coming back to it again here in June because, again, this article appeared recently, and it said some investors who aren't sold on the strength of the U.S. economic recovery are taking a shine to gold. In other words, a return to gold as being an asset class that that should, that many people think should appear as a portion of a broadly diversified portfolio. And again, this guy, William Devane, is pushing gold awfully hard on television, and as you may recall from the May webinar, the mere fact that this guy is that this company Roslyn Capital is spending so much on television advertising, and William Devane is constantly banging the drum for buying gold, got me suspicious about this whole gold. The whole proposition of investing a portion of your portfolio or your IRA in gold. So I looked into the gold statistics long term, which I'll get to in one second. But the point here, and it's a lot like Ron Paul with his scare tactics, you can see the national debt, and this is on the website. This clock actually is ticking away at a very rapid clip, and you can see that the other basis on which they're selling gold is the notion of political upheaval and financial crisis. In other words, again, scaremongering to sell us on gold. And my question was, well, is gold in fact a viable, good long-term investment? Should it be considered part of any broadly diversified portfolio? And my response is probably not. But the two propositions proposed by Roslyn Capital and others selling gold is that, number one, gold provides a hedge against a declining currency. To the extent you're worried about the Ron Paul scenario of hyperinflation and currency collapse, well then would gold protect you against that, number one? And number two, gold is a hedge against inflation long term. So I just wanted to test those two hypotheses. The first being gold being a hedge against a currency decline. And yes, in fact, gold appears to be precisely that. So in this chart, you're looking at the very close inverse correlation of gold and the US dollar. This chart goes back to 1999, so 16 years. And you can see that as the dollar declined, gold ramped higher very spectacularly. And yes, the conclusion from this period of time is that gold is a hedge against a declining currency. The problem most recently for gold investors is, yeah, but what about when the dollar puts in a great big saucer-shaped bottom here and then starts to surge in value? This has creamed gold investors. Those who took the bait and bought gold at 1,800 are now down to 1,200. So it works in reverse just as well. But I guess it's true. I mean, not I guess. It is true that gold is a hedge against a declining dollar. The question is, are you really scared about a U.S. dollar collapse long term? I don't think you should be, but if you are, gold would be a good hedge against that. The second proposition, the second basis on which Roslyn Capital and others are pushing gold is a decent inflation hedge long term. So in this set of calculations, you're looking at the inflation adjusted long-term value of gold, long-term meaning the data point start here is 1973, and in inflation-adjusted terms, gold has appreciated 1.7% after inflation long-term. So again, point number two, or proposition number two, that the gold sellers are using is gold's an inflation hedge, and that turns out to be also true. But I think the The big issue, I think, for investors long term is, well, what about the opportunity cost? And that's what I'm illustrating with this chart. It is just astounding to me what a lousy investment gold has been compared to common stocks over the long term. 5 full percentage points differential in the rate at which you're compounding long term results in a differential in an ending value of 7 to 1. In other words, $100 invested in 1973 in the stock market in real terms, in other words, after inflation, has become $1,400 compared to gold's $200, so 7 to 1 differential. And so I'm talking in terms of opportunity costs. So I guess, yeah, on the one hand, if you think it's a great idea to have a wall safe and you like to bust out your coins once in a while at a cocktail party and pass them around and so forth, you just like the feel of gold, that's a great idea because gold would be a hedge against inflation. But I'm simply saying you can do a heck of a lot better both in your own lifetime and for the benefit of your heirs if you stick with stocks for the long term, if you're willing to put up with the volatility. Also, that's part and parcel of investing in the stock market long term, which you can also see in this chart. And then the last chart I just wanted to get back to was this Ron Paul chart, the truth about the economy is terrifying. And I'm not going to belabor this or go over territory that I went yesterday, but I simply wanted to have that discussion about gold because, again, his recommendation, because he's terrified about for the future of the United States economy, and he thinks we're going to have a disaster for America worse than 2008, worse than Black Monday, worse than the Great Depression, and so on and so forth, that you should buy gold to hedge against that eventuality. I just think it's rubbish, but those are the scaremongering tactics that he's using, and he's not the only one. There are other people out there with that same set of views, but I think it's pretty ridiculous. Okay, that concludes this follow-on webinar. Thank you very much.
Nice.